I feel like, Brian, you also think that it could be a little more difficult this year. You say the path is likely to get much bumpier. You're looking for gains, obviously, out of the S&P, but 7,300 to 7,500 by year end. What's your view? This is your new outlook, which is out.
Yeah, we just published it today, and we think this. We're aligned with what Josh was saying in financials. We're very aligned with Shannon. I think about this. If you go back and look at big bull markets, year 3 of the bull market is usually the worst in the first 5 years, okay? I think we're probably going to have the year 3 of the bull market in year 4. High single digit, low double digit returns for the S&P 500, low double digit returns for Canada. Here's why. You've had some of the fundamental issues with respect to tech. We neutralized tech in our holdings, by the way. We're going to be overweight communication services, financials, and utilities. Why? I think because you can afford yourself higher amounts of tracking error with respect to those 3 sectors in particular. In terms of the longer-term secular earnings growth mode, our theme of scale in financials is still very much in place. As you've joked with me for years, financials, financials, financials. We believe those assets are still actually under-owned by a lot of institutions. And then lastly, we believe that we're going to see a rotation into 3 equity disciplines this year: value, dividend growth, and small mid-cap. Small mid-cap, to us, from a fundamental perspective, looks amazing with respect to free cash flow, and we think we're going to see a tremendous amount of M&A activity in the small mid-cap space.
Do you, look, I'm not going to say your outlook for the market is, I don't even know if I'd use the word cautious. I mean, it's not a bad outlook, but relative to what we've done the past few years, it looks more
sanguine.
Okay, it's sanguine. Now, if you would say, okay, the 24 and 23% gains that we got out of the S&P 2 of the last 3 years, you had a lot of multiple expansion, and now you finally have earnings growth. Can I make the leap and say that you don't think that there's going to be enough earnings growth to justify a bigger move in the market, because it's not going to come from multiple expansion now, because the stock market is already at 22 times, and how much more can you get a multiple to expand?
It's a great take. So if you go back and look and do an historical study of bull markets, when the bull market transitions into more of an earnings-driven market, which we're having, we believe, in 2026, the returns historically are much less, and in fact could be half as much when the market is expanding with respect to momentum in terms of a valuation-driven market. That's the kind of market that we think we're going into in 2026, an earnings-driven market. And oh, by the way, that's still positive. Positive is still positive. Just because the market isn't going to be up, we believe, as much as last year. I hope we're wrong. I hope the market just continues to go up at the same pace. I really do. But for all intents and purposes, we think earnings-driven markets, based on our research and based on where we want to be positioned in the U.S. market, we think we'll have those high single-digit, low double-digit returns.
You have a pretty good backdrop, people say, for continued strong earnings growth, and that could carry the market to even greater heights. You heard what everybody has to say. I mean, how would you assess it?
I think that's accurate. I think the tailwinds of 2025 remain in place for 2026. I think, though, given where valuations are, where sentiment is, it's probably more prudent to think about the market from a tactical standpoint. And there are plenty of tactical opportunities here early in the year. We've highlighted what we've witnessed in the money center banks and the financials. Some areas of the financials that are performing well that were not discussed are some of the trust banks, some of the exchanges like the NASDAQ, Interactive Brokers near a 52-week high, Charles Schwab doing well. What we witnessed over the weekend in Venezuela has a positive impact on FinTech, the digital banking company, New Holdings, ticker symbol NU, that's out of Brazil. So there's tactical opportunities. And today, look at what's going on in the semis. People want to talk about technology and say, okay, maybe technology isn't the place to be in 2026. That's not what's being represented right now in the semis. So collectively, you have all of this going on within the marketplace on a day when Apple is down, on a day when Tesla is down, when Microsoft's down. You look at the Mag 7, really today is only about Amazon and NVIDIA, which is kind of pulling back as well. So I think the way to approach this is from a tactical opportunity standpoint.
Okay, but that points to a different kind of market.
Yeah,
right?
absolutely.
We haven't really been in a tactical market. If you look at what the show has been for the past, not our show, but the show of the market, the last few years, it really hasn't been all that tactical. So we have a different makeup, perhaps, to this market this year.
I think the dispersion is actually, it's a good sign because it means that you're actually looking at, in this very disruptive, innovative environment, you're looking at the fundamentals of the companies, you're looking at whether it's the industries or sub-industries or company-specific drivers that are likely to put these companies in a position where they are going to be participating in that earnings growth trend for sure, but they may also be able to deliver that multiple expansion based on a perception that they are in a better competitive position.